Good afternoon. Bell Capital is excited to represent Safety Harbor as an advisor to Iowa State Teachers Pension, or ISTP. We are confident our investment recommendations are truly aligned with ISTP's preferences and strategy. As a reminder, ISTP typically aims for core to core plus assets and is risk adverse, especially given the long end of the cycle. We analyzed three key options for this investment. Option A, propose investment to ISTP with Steinbrenner's current proposed deal terms. This option not only yields low returns to ISTP, but also presents inherent misalignment between LP and GP incentives. Promising deal fundamentals led us to explore option B, propose investment to ISTP with modified deal terms. Well, this actually yielded returns higher than ISTP's required returns. There's still too much unjustified risk when compared to ISTP's risk appetite. Therefore, our ultimate recommendation is for ISTP to forgo investment. Despite capital deployment pressures, resources are better expended elsewhere. And additionally, by proposing this option, Safe Harbor retains its reputation as a sound investment advisor to ISTP. Just to give a brief asset overview, 619 West 54th is a value-add opportunity, a medical office and lab-based tenant that's 76% occupied in Hell's Kitchen. The asset is uniquely zoned for lab, and as you can see on the map, it's not in the most desirable location for transportation access. Let's dive into our deal analysis.
Thanks, Catherine, for the investment thesis, which is to forego the opportunity. I'm going to give a market analysis before we hop into the rest of our presentation. Now, before we look further in the opportunity, it's important to recognize where we are in the market as of December 12th, 2016. As we all know, we are in the long end of an upcycle. Narrowing down to Hell's Kitchen office market specifically, what we see is what has historically been a very overlooked area is now a rising submarket due to where we are in the cycle. This is evidenced by Hell's Kitchen rents exceeding the Manhattan average and vacancy tracking the Manhattan average at 9%. Again, though it has taken a lot of time, Hell's Kitchen is finally falling in line with Manhattan overall in terms of office. And furthermore, we see the growth in office is fueled by growth in the residential sector in Hell's Kitchen. This is evidenced by rapidly increasing condo prices and Hell's Kitchen residential rents matching the Manhattan median at $3,200 versus $3,250. Again, what we see is Hell's Kitchen is benefiting tremendously from where we are in the long upcycle, and the increase in residential demand brings our attention to what future office and retail needs are going forward. And I'll pass it to Graylin.
Thanks, Alana. To address the life science market, we'd like to cover three key points. The first being the real estate life science sector is growing. And secondly, New York is well positioned to capitalize on this growth. However, thirdly, New York is exposed to both political risks as well as surges in supply that are unfit for ISTP's risk-return profile. To start, the life science real estate market is growing on a nationwide basis, and this is due to the growth in personalized care as well as an aging population. Likewise, R&D development around the nation has surged as compared to our international competitors. And in addition, vacancy rates are at an all-time low for medical office space. Likewise, the New York real estate market is growing, and it's notable that this is due to public funding. New York is an academic and research institution hub and the second most funded NIH city in the nation, second only to the Cambridge market. However, this market is highly publicly funded and benefiting from public-private partnerships like that released by Cuomo on December 12th. And it is very lowly funded by VC as compared to competitors like SF and Cambridge. This makes the market highly exposed to political risks, and under the new administration, which has been critical of NIH funding, the prospects of the market are uncertain moving forward and make this a potentially risky investment in sector. In addition, New York has some issues regarding increases in zoning. At present, the property benefits from 11 academic and research institutions, but these areas are notably located outside the Hell's Kitchen core, to the areas east and west. New zoning that will be in place on December 13th will nearly double the amount of space zoned for life science. And notably, these areas will be more closely back to the academic and research institutions, like that of the Cornell Center and that of NYU. This will likely be more attractive, given the location decisions of tenants are driven by proximity to R&D hubs, and this may decrease the attractiveness of our investment that at present benefits from its unique zoning as lab. So to conclude, while the life science sector is attractive, New York has key political and as well as supply and zoning risks that make this potentially unfit for ISTP's more low risk return profile. And I'll now pass it off to Catherine.
Thanks, Graylin. To go over a full tenant analysis, the asset's 76% occupancy ratio does not fully encompass the tenancy risk in the property. As you can see, 2 floors are currently vacant, and 2 other key leases are set to expire in just a year in December 2017. Looking a little bit further, one of these leases, Volvo in the ground floor, actually announced relocation a few months ago in March 2016 and is definitely leaving the building. This presents an immense tenancy risk as the ground floor will be vacant. To look at releasing strategy, there are a few options, and auto dealerships to replace Volvo is the most obvious choice. However, with the immense supply of auto dealerships already in the area, we find negotiations with the remaining 2 main auto dealerships could prove very difficult. Other options for leasing this ground floor, based on the rise of residential in the area, include convenience, grocery, or fitness tenants. Moving on to medical office tenants, the tenants listed on the depth chart are derived from the increase in outpatient trends in healthcare, with medical centers wanting to expand their patient base. Lab tenants listed potentially have synergies with existing tenants, such as New York Stem Cell Foundation. Not only vacancies impose tenancy risk, but also the inherent lab leasing strategy, with underwritten TIs of $315 per square foot. It's no surprise that building costs in New York across any asset class are at a premium to average US build-out costs, and this is no different for lab space. With average US build-out costs for labs between $300 and $900 per square foot, having TIs at an excess of $300 per square foot is not surprising. However, there's a unique problem to this asset, and ceiling heights are only 11 feet, while the average required ceiling height for lab tenants across the nation is about 14 feet. We see this to potentially be unattractive to lab tenants looking to go to the asset, if not excessively raised TIs. Ultimately, the risk and excessive upfront cost is not justified in returns. Now I'll pass it to Carol for a financial analysis.
Thank you, Catherine. So now we're going to walk you through our financial analysis and underwriting for both option A and option B, and we'll show you how in both cases the deal remains unattractive. So here's our assumptions for base case underwriting, which is option A. Currently, the property is 76% occupied. We underwrite to a 90% expected occupancy rate, which is in line with current market as well as Steinbrenner's value-add business plan. As the highest and best use of the space is lab spaces, we underwrote a new tenant mix of 75% lab and 25% medical office. In regards to leverage, although a debt fund yields ultimately is more accretive to our returns, it could also be more predatory given if the asset experiences a cash flow shortage. Given ISTP's lower risk appetite as well as preference for lower leverage, we decided to go with the insurance loan. We assumed an exit cap rate of 4.75%, which is in line with market and represents a 75 bips discount to our stabilized yield. The case suggested that Class B office is trading around 4.75% to 5.25%. And given our property is a medical office building with longer leases and sticky tenants, we believe that a reasonable cap rate for our property would fall along the lower end of the spectrum. We underwrote an investment hold period of 5 years, as well as assumed the current partnership structure proposed in the case. Here, moving on to the cash flows, as you can see, given reasonable underwriting with proposed partnership terms, ISTP is only able to achieve a net levered return of 6.8%, 1.4 times in money multiple, and $26 million in profits. The deal clearly does not even meet ISTP's target return of 7 to 11% at a core and core plus risk profile. Our sensitivity analysis suggests that cap rates as well as occupancy would really need to swing in our assets' favor in order for this deal to be attractive. Although a cap rate compression of 50 bips could really boost returns, we believe that given we're in a later stage of real estate cycle, this is highly unlikely. Furthermore, a 90% expected occupancy could also be seen as too optimistic, given the challenging profile of our asset. Lastly, although underwriting a shorter hold period could really boost returns dramatically, this ultimately contradicts with ISTP's preferred hold period of more than 5 5 years for core/core plus assets. Now I'm going to pass it on to AJ to talk about additional considerations.
Thanks, Carol. So one of the big issues with this deal is the fact that the firm, the GP in this case, which is Steinbrenner, is able to extract so many fees. As shown by the graph, by the end of year 5, the GP has recuperated their entire equity investment. They have feed out, so to say. At the same time, the promote structure encourages excessive risk-taking due to the low hurdle rates. At 6% and 10%, the GP sees their returns skyrocket if they're able to achieve high returns, while seeing their downside case cap because they have that fee structure in place. Ultimately, this shows a classic misalignment of incentives between the GP and the LP, and we would look to change this if we were to go back to Steinbrenner. That would be done through fee subordination, where the GP would not get any fees until the asset is cash flow positive, as well as a change of the promote structure from 6 to 10% to something in the 8 to 12% or higher range. I'll now pass it to Michael to go over upside case with this different fee structure.
Thank you, AJ. So as we look into the case B scenario, we realize that our returns from case A did not hit the target for ISTP. So we really wanted to make our assumptions based off a new deal structure strategy as well as a property level strategy. And so AJ mentioned that we want to realign incentives between both the GP and LP. So the first thing we wanted to do was assume that the fees taken by GP would be subordinated until the property had positive cash flow. Next, we assumed that the hurdle rates during the promote structure would be changed to 8 and 12%. On the property level basis, we made it so that instead of renewing our tenants, we switched to 100% new lab tenants. With regards to financing the asset, we chose to work with the debt fund, which would give us much higher leverage, and exit at a 4.5 cap. Ultimately, this results in a levered IRR for ISTP of 11.34% and a money multiple of 1.64%. And while these are attractive returns and fit into ISTP's target returns, we did not believe that this very aggressive underwriting fit this risk-reward trade-off. As we look to the sensitivity analysis, it becomes very evident that the returns come largely from the sale proceeds. And while we did adjust the promote structure, we saw very diminishing marginal changes in returns. But as we sensitized both exit cap rate and achieved occupancy, these returns changed drastically. Additionally, we also modeled out scenarios within our appendices, which we can take a look at later, that show different scenarios with just medical office and traditional office. But after seeing the returns from these occupancy choices, we realized that it didn't warrant further consideration.
So ultimately, we decided to pass on this deal due to a combination of both this deal structure and the inherent risk in the asset. Now, we start off with property level risk. The asset is situated in a peripheral location and is older. Moreover, it has high leasing risk due to the vacancies, the tenant turnover in the next few years, and the ceiling heights, which are not in line with the desires of the lab tenants we were trying to attract. The second is the political risk, with the presidential election just having occurred and the new administration being stance on healthcare investments making this entire space uncertain. We could see a sharp drop-off in demand. The third one is the market risk. As there's been rumblings of a rezoning to allow for more lab space, this could really impact and create a lot of new supply in the market, which would suppress rents and exit proceeds. As these exit proceeds are what are driving returns, this would ultimately be very disastrous for the returns of this project. And the final one is the reputational risk. Safe Harbor's business is based on their reputation as a safe and reliable investment advisor. If they pursue a deal that could compromise this, it would not only have effects in the short term, but could have long-term lasting effects for their business. A wise man once said, "I want you to judge me not on my winners, but on my losers, because I have so few of them." We believe Safe Harbor should heed this advice. Now, we looked at different mitigants, but we ultimately decided they weren't enough to substantiate the looming concerns. Now, just to sum it all up, we brought forth the fact that there's a proposed investment with current deal terms, but this is more favorable for the GP and not as much for an LP such as ISTP. The proposed investment with modified terms ultimately does not meet the deal structure, does not meet the risk return profile that we're looking for. that ultimately led to our conclusion to forego this deal opportunity. Going forward, we know ISTP has $250 million of dry powder that they need to deploy, and it's Safe Harbor's duty to help them with this. Thus, we suggest looking at industrial assets. We think this is very interesting at this point in time, and we would say that in secondary markets, this would be something to approach. Now, with that, we can talk about that in further depth, but thank you for your time, and we open the floor to any questions.
He's kind. He always lets me go first. So you will never find a deal that doesn't have risks associated with it, right? Can you explain again your second scenario where you changed the promote terms? Did you, let me rephrase the question. Did you look at a scenario where you kept the leasing plan in place and where the only thing you changed was the promotes? Because in the second scenario, you changed more than one thing, right?
We did.
And what were the things? Just take me through that, because that was the scenario where you were hitting the returns,
Yep.
right? So I just really want to understand the risks that you're talking about, and just understand why they're so they're so strong that they don't, that your whatever your return was unacceptable.
Yeah. So the 5 assumptions that we changed was one that we were assuming that the fees would be subordinated. So before that, we were having negative cash flow. And then we changed the promote structure, which was number 2. Number 3 was that we changed the property level performance. So we only included lab tenants, which at this time are very hard to acquire for multiple reasons, as you saw in the market analysis. One being that you need to have 14 feet of space available for the lab tenants. The 4th change had to do with the financing of the deal, so using a debt fund rather than the insurance company. And we felt that this was a large risk, especially as the property had lots of periods with negative cash flow, because a debt fund would be inclined to take over that property. And the 5th change was assuming a much lower cap rate that we hadn't used in the base case.
So I guess what I'm asking is, what would it have looked like if all you changed was the promote structure? Because that's really like a yes or no, right? You take that to Steinbrenner and they either agree or don't agree, or you negotiate a little bit more. And so you don't introduce all these other risks that you're talking about.
Yeah, absolutely. So that falls more in line with the base case and how we sensitize around that. So if you look at the bottom sensitivity table here, we actually sensitized around exit cap and the promote structure with different splits. And as you can see, the upside and downside cases don't change too much, because the returns just don't meet a certain threshold to warrant some of those higher promotes. It'll never make it there. But that does help alleviate some of those concerns and stop Steinbrenner for just simply shooting for the fences, so to say.
Can you go back? It's a similar page, but page 20. Can you flip to that? I'm confused by the table not moving. Is that because your base case has subordination in it? Is that why? Look at the bottom 2 tranches, 90. You go to 95%, but yet your returns don't change.
Yeah, absolutely. So that's a great question. The way that we looked at it is that when we were underwriting it, there's 10 floors, and we wanted to, given how the space that lab tenants usually take up, they would occupy the whole floor. We didn't do half floor intervals. So maybe we should have rephrased this, but what you're really seeing here is that at 80% and 85%, we have the same overall occupancy for the building, because we didn't lease out, let's say, half a floor. And that's why you're going to see the same returns for 80 and 85%, and again for 90 and 95%. And if we were to showcase 75% and 70%, they would also be what is shown in the top row there.
Okay.
So you can either have an 80 or a 90.
Yes.
You can't have.
Okay.
Yeah. But we thought that the 75% showcased how low things can go with that type of drop-off.
And just out of curiosity, so if I held it for 4 years, I get to a 22% IRR. So why wouldn't you be coming to us? And I know there's factors in that, but why wouldn't you be coming to us and proposing a 4-year hold?
Yeah. Well, one of the big things that really drove that decision is it doesn't align with what the LP is looking for. They're looking for core plus assets, and 5 plus.
Why does a multiple go down to 1.4, holding it an extra year?
Yeah.
Yeah.
Do you want to?
Yeah, sorry, I can take that. So The money multiple had to decrease because we assumed that it was negative cash flow in each year, and then we're assuming that in the case it said that the loan would have to be paid back within 5 years. So we felt that because unless we subordinated the fees, we'd have to dip into equity to end up paying back the debt service.
At the same time, you do have the fact that there's a lease rolling over, right? And so in order to fund that with this case, which is a lab tenant, you have to pay a lot of TIs that over, let's say, a 4-year hold would actually prove.
So are you saying in year 5, you're taking equity to repay the debt and not putting on a new loan even though the NOI is up?
You are, yeah.
The NOI is up, but the cap rate's higher. So at that point, we wouldn't be able to refi, and we would be able to refi at a much lower value of the asset. So you wouldn't be able to repay the loan.
So we included that leasing cost instead of just assuming that cap rates were expanded or increased just to discount for that. So the way we looked at it is we could either have sold at a higher cap rate and not include that cost, or sold at a lot lower cap rate and included that cost in our pro forma.
I don't want to do too much on the numbers, but I've done one other question. On the upside case, you have a levered IRR of 41% and a Steinbrenner levered IRR of 19%.
Yeah, I can touch on that. So the way that we looked at it is to keep this ISTP return apples to apples with the base case so we can truly compare. We kept that at 5 years. However, the pro forma as a whole is 4 years because that's the one where the returns were the highest. And so that's what you would get with a 4-year hold, but it doesn't match the fund's structure. But in order to allow us to compare with the base case accurately on the same hold horizon, investment horizon, the ISTP levered IRR is 11.
So I realize that when you were given this case, you were told you either have financing package A or package B, right? So you didn't really get a chance to actually look at what financing would be optimal. Just as a point, as a lender, I would never put out money where I have a refi gap at repayment.
Yeah.
We wouldn't consider that a loan that we would underwrite.
Yeah.
So.
So can you just, I was looking in here, I saw comps, but what's your market rent that you're not able to get to a base case? Even if I understand the whole lab, which I thought was actually a great point about public versus private funding. I thought you guys hit on that really, really well, and the clear height was spot on. But what was your market rents that you're not able to get anywhere near their levered 7 to 11% returns? Your market rent assumptions.
So we based our market rent. Oh, perfect.
I saw the comps, but unless I missed it, I didn't.
Yeah, so
It's actually in our appendix.
Oh, wait, sorry, there's a lot. Yes, so for the leases that, for the new tenants, for the lab spaces, we assume a market rent of around $68 per square foot. And then for the medical office space, we assume a rent of $43 per square foot. And on a blended basis, because in base case, we're assuming 75% lab and 25% medical office, it's blending to around $63 per square foot.
But like your traditional office, you're only doing $28 a foot?
And that was based on comps that we were given.
Yeah, in the case.
And we actually did a full analysis with just a traditional office case and a traditional, I think we have it here, with a only medical office, not putting any labs because of the lower TIs that go in with just medical office, and that led to 3.64% return, which was again on the low end. And then with the traditional office, you saw it going to the negative. So really, in order to make this deal work, the lab was the necessary type of tenant we needed to get the returns that meet what ISCP is looking for.
And you didn't recommend that because you didn't believe in the lab tenants?
We think that the lab tenants are riskier and they have such higher costs to them, from TIs to the build-out period. It just does not make sense for a fund that's looking for a core plus investment, that we're a little bit later in the cycle, that if you look at the cap rates, the seller's stabilized cap rate is 5%, and yet we think that, and in turn, we think that they priced in some of that upside that comes from being one of the only lab zones buildings, or sorry, one of the only areas where it's zoned for lab space.
Did you guys visit the property?
We did not visit the property, no. Sorry about that.
Just on your base case, you said 75 lab, right? And 25 medical office. So how do you think about the exit cap that you applied? Could you have been a little more aggressive there in the base case?
Yeah, so I think we are already pretty aggressive given that, traditional office space are trading around 4.75% to 5.25%, and then we're already assuming like the lowest end of the spectrum at 4.75%. So I think even for the base case, we're already pretty aggressive in our underwriting, but that the return still doesn't work for our case.
And if you look at where we're going, I think it's,
Yeah. I just,
yeah. So we're starting out at 3.4, and obviously with the value add, you expect the stabilize to go up and then to sell a little bit lower. But if you look at where the comps are trading at in year 8 of the cycle, we are at the low end of that range, and we gave ourselves that discount because our comp set is traditional office space, it's medical office space, and we are assuming a majority of lab tenants here, which are stickier. They obviously have put a lot into the property, so they think that they want to stay in. You would hope that they would stay in for the long term, and so we've given ourselves that low end of the spectrum, and the return still just didn't work out to what we wanted to.
that combined with the risk of actually leasing and attracting the lab tenants in the first place, going back to our market analysis, it's combined a lot of risk.
Okay, that's the last question. Thank you very much.
You want to take everybody's time?